Hey traders, in today's video, I'll be covering how we can blend the use of old school chart patterns like the head and shoulders pattern, or specifically in this case, the inverse head and shoulders pattern with the wave principle. So Elliott wave theory and chart patterns are very much compatible with one another once you understand how to leverage the wave principle correctly. And then of course it goes without saying you have to be able to identify the chart pattern correctly too. The reason you might want to blend these two styles of analysis and trading together is that sometimes it can be tempting to get drawn into the weeds with the wave principle. And before you know it, you're on a tick chart trying to count out fives and threes and trying to figure out exactly how this complex correction is going to end or where it might end or when it might end. And chart patterns, the old school chart patterns like the head and shoulders, for instance, simplify things a little bit. So I'll show you what I mean. Last Wednesday in a newsletter, I wrote about the Dow Jones Transportation Average Index, and I highlighted on the 4-hour time frame chart a inverse head and shoulders pattern along with bullish RSI divergence. Now, while it's absolutely true that I did spot that pattern, the basis for my bullish bias on the index was rooted in the wave principle, and I'm going to cover that. Here, I've got a little screenshot of the newsletter that I wrote, and you can see here, I've at the bottom where I wrote, I've highlighted three key things from this chart. Number one, the red horizontal range lies between 16,418 and 16,588, and that is my initial upside target. So that would be that range right up there. So that was my initial upside target. The second and third things I've highlighted on the chart I've already mentioned. So 2 is the inverse head and shoulders pattern here, where we have the left shoulder, we have the head, and then the right shoulder. And then the third key thing I mentioned is the bullish divergence in the relative strength indicator. So that's the snippet from the newsletter. And I'm now going to take you into the bar chart of the Dow Jones Transportation Average so you can see what's happened. Well, as of right now, we've traded successfully into that target range. And, I think personally it's time to let this index breathe a little bit because the move out of that inverse head and shoulders pattern was quite sharp. And we do indeed have an overbought RSI now. All right, so where does the wave principle come into all of this? Well, it starts off with being able to count a 5-wave advance from the lows on September 20th, 2021. So I'm going to label that right now. 1, 2, 3, 4, 5. Pretty straightforward, I think. So we have a 5-wave advance, which tells me that the direction of the greater trend must be higher. Now let's just confirm that this Elliott wave count doesn't violate any of the rules and guidelines. Wave 2 does not retrace more than 100% of wave 1. Check. Wave 3 is not the shortest wave. Check. Wave 1 is the shortest wave. And wave 4 does not enter into the price territory of wave 1. All right, also check. So we have a valid 5-wave impulse, and then we have a steep corrective decline. So we're going to label this corrective decline as a double zigzag. So a double zigzag is simply 2 ABC zigzags chained together. So that looks like this. A, B, C for zigzag number 1. And then there's going to be an X wave. In this case, it is a flat correction that chains the 2 zigzags together. So A, B, C for the flat. And then we have A, B, C for the second zigzag. And all together, that comes out to look like a WXY in terms of the Elliott wave labeling. So double zigzag, all right? So you see a double zigzag when one zigzag was not enough to correct the preceding impulsive sequence. So the market decided that once we had the first zigzag, that was not enough to correct that entire impulsive advance. So we needed a second ABC zigzag to complete the entire correction. So where the head and shoulders pattern comes into play is that we got this initial advance, which we can label wave 1, and then we got the decline, which we can label wave 2, and then we got the surge up, which is wave 3, which means I would expect a protracted sideways correction in wave 4 before seeing a final pop in wave 5, and then a steeper 3-wave correction for wave 2. Okay, so where the head and shoulders pattern enters the equation is that we got a very clear classic chart pattern. And I'm just going to switch over to the head and shoulders drawing tool right now so you can see exactly what I mean. So we have the left shoulder here, we have the head here, and then finally we have the right shoulder. So instead of digging through shorter time frame charts, trying to count 5s and 3s to time an entry, it's pretty straightforward to just draw the neckline for this head and shoulders pattern and trade the breakout of the neckline, which is exactly what we got. Now, yes, this trade did take place last Wednesday, so that would have been the Fed day, which explains the surge of volatility that we had leading into that trade, and which is why we hit the target so quickly. So I like to trade for wave 3s, which is why, if you're trading the transports, either an index or various stocks that make up the transportation average index itself, my recommendation is to take a breather if you don't want to sit through what is likely to be a sideways, time-consuming wave 4. So that's just a quick video on how we can combine different schools of thought in the world, in the broader world of technical analysis, and how we can combine chart patterns and the wave principle specifically. If you have any questions, please be sure to hit me up in the comments. Thanks. See you next time.